Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello, and thank you for joining me today on Reverse Mortgage Radio. On the show today, I'm going to be talking about 4 different ways that you can tap into the equity in your home. You can sell the home, you can get a conventional forward mortgage, you can get a HELOC, a home equity line of credit, or you can get a home equity conversion mortgage, commonly referred to as reverse mortgage. What I want to do, though, is I'm going to compare all of those types of ways that you can draw the equity from your home in a standpoint of risk. We're going to look at risk today because some people say that reverse mortgages are risky, and I don't know about how they're risky compared to the other options that are available. That's what I like to talk about. So I appreciate you being here today. I like to start off the show with what is a reverse mortgage, because a lot of people are tuning into the show now. Actually, I think it might be growing a little, which is always good. I like to get the word out about reverse mortgages and how they can help you or not help you one way or the other. But I want to give you the information so you can make an informed decision for yourself or your family, talk to your family about it, things of that nature. Most of the time, reverse mortgages are an FHA insured loan. Not all reverse mortgages are FHA insured, but that's what we focus on mostly on this show. I've done shows in the past about proprietary reverse mortgages, which are non-FHA insured loans. But again, today I'm going to be focusing on the FHA insured home equity conversion mortgage program. And that's a loan that's specifically designed for people that are 62 and over. It allows you to convert a portion of the value of your home into money that you can use however you want. Any money that you get from the reverse mortgage has to first go to pay off any existing loan that you have on your home. And unfortunately, that's kind of a challenge in today's market because the way we calculate how much money we can loan on a reverse mortgage is based on the age of the youngest homeowner, the value of the home, and the interest rates. In a nutshell, the higher the interest rate, the younger the homeowners, the less money you qualify for. Since rates have been going up, now they've kind of plateaued a little. I know in forward mortgages they're coming down somewhat, but in the reverse world they're kind of holding steady. And what happens is with rates being where they're at now, we can typically loan most of the time between 35% of the value and roughly 50 to 60% of the value. If you want to get close to the 60% value to where you can borrow 60% of the value of your home, you need to be well into your 80s in order to get that, because the older you are, the more money you can get. Somebody in their early 60s is going to be closer to 35% of the value, early to mid 60s. That's just the way it is right now. But if you get the reverse mortgage, you're charged interest every month, but you don't actually have to pay it. There is no monthly payment of principal or interest required on a reverse mortgage. Now, the home stays in your name. It's still yours. You have to maintain it. You also have to pay your own property taxes and your own homeowner's insurance because it's your house, right? You have to live there as your primary residence and keep your name on title. As long as you do those things, no payment is ever due on the loan. The loan only comes due when the last homeowner permanently leaves the home or if you fail to pay your property taxes or insurance or things of that nature. Maintain the home and such. So as long as you do those things, you never have to make a payment on it. But you're still charged interest every month. If you pull out $100,000 on your reverse mortgage and the interest rate's 7%, a year from now, this is just roughly speaking, not exactly, but I'm simplifying it. you would owe $107,000 because that $7,000 in interest was not paid throughout the year. Now, it's really going to be more than that because the interest compounds monthly, and you need to be aware of that. I'm very, very clear with people when I'm going over numbers with you. We provide something called an estimated amortization schedule, and it shows how the loan balance grows over time because you're charged interest every month, but you're also charged mortgage insurance. All FHA insured loans, not just reverse mortgages, but all FHA loans have mortgage insurance on them. The mortgage insurance protects the lender. Basically, with a reverse mortgage, you're thinking, wait a minute, on a forward mortgage, there's only mortgage insurance if you borrow more than 80% of the value, and that protects the lender as well. So if the lender has to foreclose on you and they can't sell your house for enough to pay off the mortgage insurance covers the loss for them. Okay, that's why there's mortgage insurance. But then after you reach down to 80%, you can refinance, or I don't know, it used to automatically fall off. I don't know forward mortgages. All I do is reverse. But then what happens is that mortgage insurance is no longer on the loan. So you're not charged it once you're below 80% of the value, right? With reverse mortgages, you're only borrowing, say, 35 or 40 or 50% of the value to start with. Why would you have to have mortgage insurance? The reason is because we don't know how much you're going to end up owing as a percentage of the value of the home. You could eventually end up upside down on this loan, meaning you owe more on the home than it's actually worth. That happened to people in 2008, 9, and 10. And in those situations, the people who continue living in the home, they just continue living in the home, paying their taxes and insurance and maintaining the home. Nothing changed. They still had access to all the money from the reverse mortgage if they were getting monthly payments or they had a line of credit. That money was still available to them even when they were upside down on the loan. And we're going to touch on that situation in comparing a HELOC loan to a reverse mortgage and what happens when you have a HELOC loan and that happens. So, but the thing is that then they just held on to that house and they stayed there. They didn't have to move or anything. And the value came back. And they were in a positive equity position in 12, 13, 14, 15. So nothing happened, nothing changed. The only time the mortgage insurance came into play was when people had to leave their home when they were upside down on the loan. And in that situation, the heirs still inherit the home. So the heirs inherit your home. Now, normally, if there was a lot of equity, like right now, let's say you pass away with a reverse mortgage and the house is worth $500,000 and you have a $200,000 reverse mortgage on it. Your heirs can sell the house for $500,000, pay off the $200,000 that's owed, and they can keep the $300,000 in equity. Or they can keep the house. They just go get a new loan, pay off the reverse mortgage loan for $200,000, and they keep the house and all the equity. So it's a good deal. But if you owe $200,000 on the loan and your house is only worth $180,000, what then? Your heirs are not responsible for it. That's where the mortgage insurance comes into play because the mortgage insurance will cover the lender for any potential loss. And so, or for any loss, I should say. And so because the lender's not losing any money, they're not going to come after you, your estate, or your heirs for any loss, any money that they lost. That's called a deficiency balance. And that did happen, excuse me, in the past. And I think it can happen now. I think actually President Obama in 2009 or 10 stopped companies. He with some executive order, didn't allow companies to pursue a judgment, to get that judgment against people who lost their home to try to collect the money. So they just wrote it off, and then they would send you a big old 1098 saying that they forgave $50,000 or whatever, and then you had to pay taxes on that money. Woohoo, isn't that great? So anyways, but we'll talk about all those details, comparing a forward mortgage to reverse and things of that nature. If you have any questions about this program, about reverse mortgages at all, please call me. My name is Bruce Simmons. I'm the reverse mortgage manager for American Liberty Mortgage Incorporated right here in Denver, Colorado. You can reach me directly at 303-467-7821. 303-467-7821. That's my direct line. Visit me online as well at reversemortgageradio.net. reversemortgageradio.net. I'd love to have you go there. download my consumer guide for reverse mortgages. It's about 40 some pages. If you want me to mail you a hard copy, give me a call or shoot me an email, and I'd be happy to stick one in the mail to you so you don't have to print out 40 some pages. But I'd love to do that for you. I just want to get the word out about reverse mortgages so people can make an informed decision. But the thing that drives me crazy a lot of times is and I hate to use this term, misinformation online. And and I'm not calling for censorship or anything like that, but people post things. I was just looking online today because I was revising some stuff on my website that's outdated. I was updating my site and I was looking up some information. I saw on there an article that was supposedly updated May of 2022. And in that article, the author, who is just a contributing columnist to Investopedia, which is supposedly a very good site. They talk about a lot of different terminologies for investments and things of that nature. But this lady didn't understand reverse mortgages because she said if the borrower had to leave the home permanently and there was a non-borrowing spouse, that the non-borrowing spouse would have to pay off the mortgage or sell the house or get foreclosed on. And that just flat out is not true. That goes back to 2014 when FHA changed that law, allowing the non-borrowing spouse to stay in the home. Now, in her defense, there was just a change last year in 2021, I think, where they allowed if the homeowner had to go to, or the borrower had to go to assisted living, then up until 2021, the non-borrowing spouse did have to pay off the loan or sell the house or whatever because the borrower didn't actually die. And in this case, I'm talking about the borrower being the spouse who actually the loan is in their name of. And I've done whole shows on non-borrowing spouses. I'm getting into the weeds there, and you probably don't even know what the heck I'm talking about. But anyways, there is information online that is not accurate. Another one I saw had some other misinformation about it, or not. It was old. Let's just say it is old information because there's been a lot of changes in the last dozen years or more on reverse mortgages. And for the standard columnist or even a forward mortgage person, they just don't keep up with it. That's where it's important to deal with a reverse mortgage specialist like me. All I do is reverse mortgages. I don't do any conventional mortgages. I don't do HELOCs. I don't do insurance. I don't do investments. Well, I try to do investments for me, but buying Bitcoin at $60,000, what a great investment, right? No, I didn't do that, but I know people that did. All right, let's talk about this. So the 4 ways that you can draw money from the value of your home, how you can tap into the equity. You could sell the house. You get 100% of the equity minus 7% or whatever closing costs. That's the best deal. You get all the equity, but what do you do with it? You've still got to find a place to live, right? That's great if you're going to be a nomad or just drive around in your RV, which I've talked to people who did that. And that's awesome. They went and saw the country and things, and that's a great idea for some people. But most people still need a place to live. And it's inconvenient, it's expensive, it's you've got to find a new place to live, all that stuff. And so it's not really the best way for a lot of people because they don't want to move. This is something else. The guy that Dave Ramsey, he likes to talk a lot about finances and paying off debt. He's so anti-debt, but I just don't think he factors in people's emotional attachment to the house. A 75-year-old lady I saw on YouTube, she calls in. She says, well, I'm thinking about getting a reverse mortgage to fix up my home because I haven't had the money to pay my home. She had good income, like $5,000 a month from pension and Social Security, but she just didn't have the money. He's like, well, what have you done with all your money? She's like, well, I have $50,000. My financial advisor says I shouldn't use that money. And I have medical bills and things. I don't want to leave my home. He says, well, you should sell your home and sell your home because it was a $650 home. He says, sell your home, buy something for $400 and pocket the $250. Well, that's just so stupid. He doesn't know, number one, if she even owned her home free and clear. She never mentioned it one way or the other. She might have a $250,000 mortgage on her house. So then could get $400 from it, not counting costs. And then she might not be in an area where she could get a new home for $400,000. So that just is not being a very good listener in my mind. You want to listen to your customer's needs. Now, this lady is not his customer, but she was a listener. She would listen to his show and she called him for advice. And he's basically spitting in her face in my mind. That's the way he's looking at it. So selling the home is not right for everybody. For some people, it's great. And in that case, too, you could, if you wanted to, you could get a reverse mortgage to buy the new home and maximize the amount of money that you can cash out from the sale of your old one. You could get a conventional forward mortgage. Okay, that's a great way to get extra cash, lower your rate or whatever, lower your monthly payment if you're refinancing at a lower rate. But remember, you've got the mandatory monthly payments. And is it more risky to have a mortgage like a reverse mortgage with no payment, or one that you have to have make $1,000 or $1,200 or $1,500 payment every month, or even $500, whatever the case may be? Where if you had an emergency happen, you ended up in the hospital for 2 months, or your husband ended up in the hospital for 2 months, or you had a furnace blow up or conk out, now you need $10,000, things like that. And now it's going to put a strain on your budget and you can't make that payment. What's going to happen if you don't make that payment? They'll work with you a little bit, but it's going to be a very big challenge to get that caught up. And if you can't get it caught up, you could lose the home. So is that more risky, or is a reverse mortgage where you don't have a payment to worry about more risky? I think that's a check in the reverse mortgage box for me. Also, too, with a forward mortgage, remember, you've got to qualify. And not the qualifying standards are more difficult for a conventional mortgage than they are for a reverse mortgage. We have a little more flexibility in how we can look at your debt to income ratio, how we look at your expenses, things of that nature. Okay. Let's look at a HELOC, a home equity line of credit that you get from your bank. Granted, those are super cheap to get. Sometimes there's no cost at all. Other times it's $500 or something to set it up. And that's great. You get a $50,000 or $100,000 line of credit. If you use it, you've got that nasty old payment again. And again, let's carry it back to the reverse mortgage system. No payment versus payment. Which is more risky? The payment is more risky. Also, too, how's that line of credits work for you? Ask anybody in 2008, 9, or 10 what happened to their home equity lines of credit when property values dropped by 30 or 40%. What happened to the line of credit? It went away like that because the underlying asset securing the loan dropped by 40% or whatever. So the bank they reevaluate this, say, that $80,000 line of credit we gave to that homeowner, we're going to have to get rid of it. He owes $20,000 now. Let's cut it down to $20,000. So they're not calling the loan due, but they basically eliminate your line of credit. I talked to numerous people who had that happen to them in the financial crisis in 2008, 9, and 10. And so that line of credit is not guaranteed. The other thing is most HELOCs are only good for like 10 years, at which point you need to requalify to keep the line of credit open. And if you cannot requalify to keep that line of credit open, then you have to start making not only just interest-only payments, but you have to start paying principal and interest. So they basically recalculate the payment on like a 20-year, 15 or 20-year term, and now you've got to make that payment on that at that term. That happened to a customer of mine who called me back. This was, I think, in the mid-2015, something like that. He was a real estate agent, and he wrote everything off. I mean, his off on his taxes. He showed almost no income, but Wells Fargo was able to give him, he had good credit, so they gave him a line of credit. He retired after he'd had that line of credit 6-7 years, something like that. Well, 10 years came up, and he wanted to renew that line of credit. They turned him down because his Social Security income was only like $680 a month or whatever. It was in the 600s, I'm almost sure. He came to me, and I was able to qualify him to get a new HELOC or a new HECM line of credit, home equity conversion mortgage line of credit, because we look at income differently. We were able to qualify him because we looked at all the equity he had in his home, and we were able to count that as if it were income. So there's those things. So that line of credit from a HELOC is not guaranteed. That money may not be there when you need it. So which is more risky? The HELOC that may not be there when you need it, with a monthly payment that may increase because of as interest rates go up on that. The HELOC is also an adjustable rate, so as interest rates go up, your interest-only payment goes up. But then if you cannot requalify to extend that line of credit, then your payment's going to jump dramatically because you have to start paying back principal as well as the interest. Now, with an FHA-insured home equity conversion mortgage, it's FHA-insured, so it's guaranteed by the federal government, which is, I'm not a big fan of government, in all honesty. I think most of the time they get in the way. But the FHA mortgage insurance program is self-sustaining. Maybe most of the time it is, I should say. I don't know the entire history of it, going back to the 30s. But it's pretty much self-sustaining because it's paid for by the people who use the program. So there's no monthly payment required. However, if you want to, you can make payments. You can pay down the loan balance so you're charged less interest. If you choose the line of credit option, that line of credit can never be closed on you as long as you continue to pay your property taxes, your homeowner's insurance, live there as your primary residence, keep your name on title, and maintain the home. As long as you do those 5 things, that line of credit can never, ever, ever be closed. If you and your spouse are both over 62 at the time you get the loan and you're both borrowers, if something happens to one of the borrowers, one of you passes away or has to leave the home permanently, the loan continues on. You don't have to requalify. No, that loan is continuing on. If you've got $100,000 in there, you'll keep $100,000 in there. Okay? Actually, that's not even correct. That $100,000 line of credit you have actually grows over time, increasing the amount of money you can draw from the line of credit at a later date. Now, any money you're taking from that line of credit is borrowed funds, even the money that we increase the line of credit by. If your line of credit goes from $100,000 this year to $108,000 next year, then that extra $8,000 is not free money. You didn't earn interest. It's just extra money you can borrow from the reverse mortgage. Keep that in mind. The other thing that's really huge about this loan is because it's got that FHA mortgage insurance on it, like I mentioned before, there can be no deficiency judgment taken against you, your estate, or your heirs. If you end up owing more on the home than the loan is, or more on the loan than the home is worth, the bank or lender can never come after you, your estate, or your heirs for any loss that they incur on this because they're not losing anything. The mortgage insurance will pay them any loss, making them whole. So because they don't lose anything, they're not going to come after you, your estate, or your heirs. There's no such thing as a deficiency judgment with a home equity conversion mortgage. Keep that in mind. And that's so important because you've got to have that peace of mind that the absolute worst case with a reverse mortgage is that there's no equity left in your home. That's not likely when you're only borrowing 40% of the value today, okay? Even if the rates go to 7, 8, 9%. And you're being charged interest on all that money at 9 or 10%. Now, there's caps on the interest rates too. So if you take out a loan today at, say, 7.5%, the interest rate can never increase by more than 5 percentage points over the life of the loan. So it can never go above 12.5%. But again, this is the risk factor. As the interest rate goes up, it does not impact you directly because you don't have to make a payment. If you've got a HELOC loan and the interest rate jumped by 5%, your interest payments will increase. So you have to pay more money to keep that loan in place for the same amount of money you're borrowing. Keep that in mind. So again, all right, so we talked about the non-recourse thing. The other thing too, from an investment standpoint, if you have money in the market, even if it's just $100,000 or $200,000 or $50,000 even, if it's invested and the market drops by 20%, now you need that money. So you had $100,000, now it's only $80,000. Well, now you need to take out $20,000 when it's down, of course, that's what happens. Now you only have 60,000 in there because you had to pull it out. And if you originally put 50 to start with, and it rose to 100 and then it fell back down to 80, you might still have to pay taxes on that money, even though you're taking it at a loss from the top of 100 down to 80. So with a reverse mortgage line of credit, we call it a standby line of credit. You don't need the money now. You don't even need a reverse mortgage at all now. So you set that money aside in a line of credit. You set up the line of credit. Don't take any money out. You've got $100,000, $200,000 in that line of credit. The stock market drops. You've got money in the market. You need the money now. You promised your grandchildren that you were going to pay their tuition for this semester, or you need a new furnace, or your car engine blew up. Whatever the case may be, you need some cash. You don't have to take it from depreciated assets that you have invested and you're taking a loss on. You don't have to sell investments at a loss to get that cash. You tap into the reverse mortgage. And you're like, well, I hate being charged that interest on there. Well, then when the market comes back, you take the money from your investments at that time, pay back the reverse mortgage. Now all you've been charged is the interest over that last 6 months or 8 months or a year or however long you had the money for. So this actually helps to increase the safety of your investments and your financial well-being. I always tell people the goal of the reverse mortgage is to relieve financial stress, not create it. And so if you can relieve the financial stress of an up and down stock market or up and down bond market, the bond market has been terrible this year as well as stocks. So if your financial advisor says, put money in the bonds because they're safe, well, now you've lost money on that too. So keep in mind that a reverse mortgage is not risky compared to the other alternatives at all. In fact, I think all of the others are a lot more risky than a reverse mortgage. And it irritates me when I see things saying reverse mortgages are bad, they're terrible, they're risky, they're expensive, on and on and on and on. Yeah, and we'll talk about closing costs here in an upcoming show here, because I think it's been a while since I've talked about that. People say, well, they're expensive. Compared to what? What can you compare a reverse mortgage to? You can't compare it to a conventional mortgage because they're completely different. Even a HELOC is different than a HELOC. It's difficult to compare it to anything. An annuity, maybe you could compare it to. I don't know. We'll talk about the closing costs though in another show. But I just think that it's important to understand that how risk is evaluated, and you need to evaluate it for yourself. How you look at things. You are losing equity in your house. You would not have as much equity if you get a reverse mortgage 10 years down the road as you would if you didn't get a reverse mortgage 10 years down the road. So keep all that in mind. Feel free to call me with any questions. My number is 303-467-7821. My name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage here in Denver. 303-467-7821. Or visit me online at reversemortgageradio.net. Thank you so much for joining me today. Hope you have a fantastic day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.